Hey everyone, and welcome to this week's On the Spot. I'm Zach Strickland, and here with, as always, John Paul Hampstead, our Director of Passport Research here at FreightWaves. And JP, let's dive right into it, man. We've had, we weren't here last week, getting ready for our 3PL summit, but
right.
The market continues to show signs of significant strengthening. We've seen volumes after the 4th of July continue to show elevated levels reminiscent of March.
Yeah.
Tender rejection rates up over 17.5%. Not quite as high as they were in March just yet, but the sustainability of this curve is a lot stronger than it was back in March. The March volumes and tender rejection rates shot up in a matter of a few weeks, and they were right back down in a matter of a few weeks. This one has grown since early May on the volume side, with a few little hiccups here and there, specifically right after the 4th of July. And now tender rejection rates again have this slow curve, and now they're, I want to say, slightly plateaued, but we've been over 15% on the tender rejection rate for the entire month of July.
And now we're at 17.5%. It just went up actually pretty decently yesterday.
And what's interesting, just to put context around that, we were over 10% in 2019 for 4 weeks total, and that was all around Christmas.
Yeah.
And they went up and then right back down.
Right. There are a couple of other things that distinguish the current volume rally from what happened in March. One of them is that dry van is outperforming reefer right now, which is different than March, which was, again, like a lot of grocery. We really think that there's been just a pronounced consumer mix shift toward goods out of services. And you see that in really, one of the most expensive markets right now in the U.S. is outbound Southern California, right? So to me, that's consistent with people buying imported finished goods, retailers selling a lot of stuff, e-commerce booming, and things like that. And I also think that the guidance that some of the transportation companies have given in their second quarter earnings calls makes me think that they also believe that the revenue rally, if not, which is a derivative of volumes and rates, right? The revenue rally has legs. Like, I think one of the things about this quarter is that it's really a moment where our data, our editorial coverage, and our research has a chance to shine, because when we think of a quarter like the second quarter of 2020, we see a very granular, multidimensional curve, right? That takes into account rates, volumes, tender rejections, things like that. But on a financial statement, it's boiled down into a point, right? Like, what was your revenue? What was your rate per load mile? What was your gross margin percentage for, averaged out across an entire quarter? And so yeah, I just think that you really have to dig into the management commentary for this quarter and really see how they're guiding and what the trends were from April, May, June, and then now in July, to kind of understand what's going on.
Yeah, I mean, you're talking about 3 months where, just to illustrate a little bit further, the average of 1 in 100, is 50, or 0 in 100 is 50, but the average of 40 and 60 is also 50.
Yeah.
So, just because, and a lot of these numbers are just averages of what's traditionally not as volatile as what we've just seen. And the month of April, as we saw in our data, extraordinarily depressed, very slow, a lot of low volumes. And then, of course, June was a robust recovery, and May was the transition of that. It was not a flat month at all. None of these months had any kind of flatness to them. And the way that you're talking about it is the fact that normally you have this seasonality that's pretty comparable year over year. I was looking at Night Swift earnings, and what was interesting to me is that, their revenues were down slightly. Their OR actually went down, which is good, slightly, meaning that they had increased operational efficiency on less revenue. Some of that had to do with fuel, et cetera, but
some had to do with maintenance too, I noticed.
Yeah.
$16 million less maintenance.
If you're not driving as much, which they didn't, there's less maintenance cost and whatnot. But again, they were expecting this just really bad quarter, And to know that the average of those 3 months together, including one of the worst months ever, that means that June for them had to have been really strong to pull them back into alignment with the previous
And also
year.
think it just speaks to the sort of operational discipline of their management team that they I think the way that we would have imagined it, if just hearing about the quarter without maybe living through it or being an outsider to the industry would be that, okay, depending on their customer mix, revenues were up or down, but surely the trucking company would be less efficient because of all this network imbalance and dislocation that we've been hearing about. But Knight-Swift really kind of outperformed in that regard.
Yeah.
Right. If you think about higher empty miles, like more demand in places where you're not supposed to have more demand, and less demand in places where you are. They were able to manage through all that really well. There are a couple of kind of interesting volume numbers because to look at across the sort of the companies that have reported so far, because a lot of people OTVI has been elevated for a while, and we talk about how that's sort of tied to the contracted freight coming out of large shippers going to large asset-based carriers for the most part, although it contains lots of modes, lots of commodities.
You saw some interesting numbers across the board in terms of how it related to, kind of something that described contracted versus spot.
Yeah. So JB Hunt truckload volumes were up 17.4% year over year in the second quarter, up 17.4%. Echo truckload up 3%. JB Hunt ICS, which is their brokerage, down 10.5% in volumes, and then Landstar down 16% in volumes for the quarter year over year. And so you get this range, and I think the way to think about the discrepancies between those companies is to think about their sort of revenue mix of contracts, or the volume mix of contract and spot,
right?
On the assumption that contract volumes recovered first,
which makes sense.
And then as capacity tightened, you get tender rejections piled up, and then volume started flowing into spot, which recovered later.
Right.
So Landstar, guided that they still think they have a pretty good quarter ahead of them. Whereas I think other companies are a little bit further along in sort of the volume recovery.
Yeah, I want to talk a little bit about a common question that we get. We were talking about it before the show, is the relationship between spot and contract in terms of how spot rates move with contract rates, and how one leads the other. And typically, we hear a lot of talk around, well, contract rates when are they going to go up? Well, the mechanism of contracts themselves has a 12-month cycle in general. Now, there's mini bids and rollouts and things like that happen in between these cycles, but traditionally, it takes a period of time before the contract rates are a product of the previous 12 months.
Yep.
So it takes a lot longer for those to start to drag up. There's not a moment in time where, okay, we have a hot spot market like we have right now, all of a sudden contract rates jump 3%. That's not how it works. Typically,
and even if a transportation company executive were to say that we're seeing contract rates move up about 3%, they might be talking about the 5% of their contracted business that they're currently repricing and negotiating, right?
Which traditionally doesn't happen in July.
No, it's not. It's concentrated in Q4.
Q1 is when implementation normally happens. You can see that reflected pretty cleanly in the Cass truckload line haul index. Year over year, a lot of the more significant drops or changes occur in January, and that's because you have contract implementations that take full effect beginning of the year, again, for budgetary purposes for a lot of these shippers. It doesn't mean that there's several companies out there that have bids in the year, and of course their fiscal year differs, but I think the question will be is how volatile will this next period be? The fact that we're seeing so much volume pressing through the market at a consistent pace, even we've plateaued in July, and tender rejection rates continue to creep higher.
Yep.
One of the big questions is how sustainable is this environment? And to me, we're watching the ocean, we're watching the industrial economy, because technically this freight market has not had an industrial economy to drive it at all. Capital expenditures are still well below the rest. Industrial economy has not started. It's just now starting to show signs of recovery on the rail carload side. We watched chemicals and some of the total carload volumes, things that are indicative of
automotive,
raw materials moving through the country. This is the stuff that leads a lot of that dry van freight, because this is production materials, this is the oil and gas industry, energy, things like that drive a good part of the economy. And the freight market does derive a lot of value from that. And we have not seen that really kick in yet. So we've been living on this supply chain dislocation and this adaptive measure by a lot of shippers trying to get in front of this demand as the consumer starts to reorganize their lifestyle as well.
So what I'm hearing from you, Zach, is that while the sort of absolute level of spot rates affects how shippers may be thinking about whether they need to adjust contract rates up or down, it's also the what can we learn from the last 12 months? What does the last 12 months or the last 6 months, for example, actually tell us what conditions are likely to be in 2021? How much can we actually infer from what's happening now? Is this weird? Should we really make long-term adjustments to our contract freight based on all of this sort of really unusual thing that's happening right now? And I just think that maybe in the 2017, 2018 upcycle that started, there were talking points around the ELD mandate that at least allowed the market to believe that there was
a story to go along with it. It made sense to a lot of people to be like, all this capacity is leaving forever.
This is a permanent constraint on capacity, things like that. I do think that there are fundamental issues with capacity in the market, but it's really hard to see those signals through all of the noise, right? One thing I will say, though, is that on the J.B. Hunt earnings call, Shelley Simpson did say that she believes that purchase price or contract rates are already moving. Doug Wagner, a little bit, maybe behind that. He kind of says that he's waiting for more spot volumes to go up before he sees, significant upward pressure on contract rates. So it's kind of interesting just to see. I think most companies are in widespread agreement that both on the demand and supply side, things are pushing rates up. There's a little bit of disagreement over sort of how far out that inflection point is.
Yeah, it is very hard to see right now, and we only have about 30 seconds left. But I think the takeaway here is that we're only a month into elevated spot rates, a month and a half into elevated spot rates. Really, we were just around 6% tender rejection in the middle of June. Now we're up over 17. It hasn't had a long enough stretch. There's still a ton of uncertainty over what that means moving forward. For now, you have to really stay focused on what's moving in the market, the type of goods that are moving in the market. We still have a bunch of retail, consumer products, I should say, that's really moving. The needle. Supply chains are repositioning a lot of freight still. So we'll have to wait and see. But for now, the market remains hot, and it looks like it's not going to slow down here in the near term.
No.
Yeah. Well, thank you so much for tuning in this week, and stay tuned to FreightWaves.com for any future freight market updates. Have a great week.